For more on the tech rack, let's bring in Mark Mahaney, head of internet research at Evercore ISI. Mark, great to have you with us.
Hey, Melissa.
What do you tell clients, and how receptive are they to, I think it's a buy rating, the long-term fundamentals are great, I don't make calls for the next 6 months, I make calls for the next 12 months? Because if you had said that a couple months ago, they'd be down now, and it'd be pretty painful.
Well, you stick with your discipline. You always look for what I love to look for is DHQs, dislocated high-quality companies. We didn't have any at the beginning of this year, except for Uber. Uber was our top pick. I thought at 60, the thing was way dislocated. I think you now may have another one, which is Amazon. I particularly like Amazon with the sell-off here. We just bumped it up to be our #1 pick. You want to be disciplined about where the stocks are. Look, we had a 2.5-year rally, super rally in S&P 500, more so in NASDAQ, even more so in the internet large cap names that left very few kind of compelling valuation startups at the beginning of the year. But, you continue with a correction like this, you're going to find really interesting, aggressive price points. So I'm stick with my two most interesting price points right here are, our Uber and Amazon.
What is the worst case scenario in your view in terms of valuation or any other metric for that matter for Amazon in the case where AI CapEx gets curtailed, or spend on AA gets curtailed, and there's a severe drop in consumer sentiment, consumer confidence, such that, the retail portion of its business gets hit too?
Well, I guess I would look at two things. I'd look at where the multiple is versus where it's traded in the past, and 25 times earnings is the cheapest you've ever had a shot at Amazon. Doesn't mean it couldn't be cheaper than that. Look, we've got if we can get overbought, you can get oversold. I'd be very surprised to see a name like Amazon trade down to 20 times earnings, but it's possible. That would have to be that there are real fears that this consumer softness is going to cause negative revisions on to Amazon numbers for the year. I don't think that's the case, not from everything that we've checked so far. Look, almost all consumer demand trends, when we looked at the most discretionary of the sectors I look at, like travel, I looked at retail, I look at advertising, mobility, delivery, those results were stronger going into 25 than they were going into 24. Maybe all this is inflected down in the last 2 weeks. I'd be a little surprised by that, but it's possible. But barring major evidence that we're really going to have a negative earnings revisions, I guess that's what Melissa, I'm kind of trying to listen to the stocks a little bit. If Amazon trades below 25, then that's the market telling you that they think there's material negative revisions coming up. If you have belief that that's going to happen, then you stay away from the stocks. Right now, I don't believe that we're going to have negative revisions, so I'd be waiting in here, buying some of these names, but I'd be very selective about it. Start off with the ones that are most dislocated. In my book, that's Amazon, then Uber.
Mark, Dan brings this up, so I'll bring it up as well. Everybody talks about CapEx. CapEx has been sort of the backbone of this. But, if you see a slowdown, CapEx isn't etched in stone.
Yes.
So if you're to see people starting to pull back, how impactful could that be?
Yeah, it'll be kind of an amplifier impact. So wait a second, your business is slowing. You're accelerating your spend in CapEx. I think most of these companies, particularly the big three, I'll just stick with those, Meta, Amazon, and Google, have good ROAI data points, data points that prove that their investments, there's at least some payoff. Google being able to say, I love these 25% data points. Google is telling you that 25% of their code now is being written by AI. That has some real interesting implications in terms of keeping headcount flat going forwards. Amazon telling you that in its most advanced distribution centers, they're seeing a 25% reduction in cost to serve. That has dramatic implications for margins at Amazon going forward. So as long as you get those kind of data points, we're fine. But yeah, I would imagine if there's a dramatic downturn in end market demand, not just for a quarter or two, but really it'd have to be substantial, then maybe you'd see these companies take down CapEx. I'd be very surprised to see that in this year.